Welcome. Thanks for joining us. In this video, we're going to provide an introduction into Magellan's quality scores and why our definition of quality is differentiated. We'll provide company examples along the way to illustrate the differences. We hope that you'll take away from this video that Magellan's definition of quality is considered and thoughtful. Magellan's definition doesn't rely on quantitative metrics. We define quality companies as those that have unique attributes that enable the company to earn attractive, sustainable returns over the long term. We assess 6 quality factors in our definition. As we step through the 6 factors, it's important to understand that Magellan's definition relies on fundamental, forward-looking research that comes from our team of investment professionals. We focus on the future. This process is supported by debate amongst our analysts, within the sector teams and with portfolio managers. This process requires approval from investment committee, and those quality scores are continuously monitored. This is Magellan's DNA. It's more than a decade in the making. Magellan's DNA is the implementation of our proprietary definition of quality, and that's the research that underpins our universe. Okay, back to our definition. We research companies and industry attributes that allow the investment team to score companies on moat trend, business risk, agency risk, reinvestment potential, and ESG risks and opportunities. This definition gives us conviction in the company's ability to generate sustainable through-the-cycle returns for investors for decades to come. This gives us conviction in investment outcomes for investors. For each of the quality attributes for all companies, we qualitatively grade each of the metrics, with most of the metrics over a 5-point scale. The purpose of the grading is to give the investment team an overall picture of the quality for each company. Now let's step through each of the quality scores. First, we have economic moat. Here we are identifying the attributes that enable a company to generate sustainable earnings over the long term and also into the future. Some of the attributes include, for example, looking at scale advantages, industry structure, pricing power, barriers to entry, network effects, and switching costs. The research isn't a simple tick box. It's understanding the industry, understanding the consumer, the regulatory landscape, and the company's positioning. Microsoft is a great example of a quality company. Microsoft is the world's largest enterprise software company and a leading cloud service provider. Windows is the dominant PC operating system with more than 90% market share. It has the largest ecosystem of users, developers, tools, and applications, which has made it difficult for alternative operating systems to compete. Switching costs for consumers are high because they know the Windows software intimately. On the cloud side, Azure is an industry leader, along with peers AWS and Alphabet. Azure possesses leadership in scale, capability, and reliability, and these are its sustainable competitive advantages that the industry continues to benefit from. On the other end of the spectrum, we have energy companies. We don't view these to be quality. And this is because their earnings are linked to commodity prices. That is the supply and demand of the underlying commodity. It doesn't have those quality attributes like Microsoft does. Next, we assess moat trend. We look at the trend of that moat, and the direction is an important indicator of the future opportunity of the firm. This is an important factor as it is multidimensional and it has that forward-looking lens, and it's not just a static number. United Health is a great example of a company with a positive moat trend. United Health is America's largest private health insurer. United Health is a clear leader in the sector's transition to value-based care, and it benefits from the important first-mover advantage in the shift towards vertically integrated care delivery model. Whereas on the other end of the spectrum, we have banks. For those quality banks that make it into our universe, we do view that they have a negative moat trend, driven by the risks to open finance, because those sticky retail deposits that we love are at greater risk. The next metric is business risk. Here we're looking for the predictability of earnings. Now, risk might be generated from the economic cycle, from the forecast ability of earnings, individual business models, or geopolitics. Nestlé is a great example of a lower risk business. It's the largest food and beverage company in the world. It's lower risk because there's predictability in earnings, given the market positioning in the consumer staples space. Whereas we may apply a higher risk rating to companies with greater exposure to economic risk, or greater uncertainty in forecasting earnings, or greater uncertainty in forecasting the total addressable market. Next, we have agency risk. This is the risk around deployment of cash flows and conviction in management. MSCI, one of the largest index providers and analytics companies in the world, we view to have a low agency risk. This is because we're positive on management's ability to allocate capital and to execute. Whereas there are some companies that we may rate higher risk or exclude from our investable universe due to risks presented by governance structures and the uncertainty in capital allocation. Next, we have reinvestment potential. This is the through-the-cycle sustainable growth in a company. Investing in companies with high reinvestment potential gives us greater conviction in future cash flows. Visa is a great example of a company with high reinvestment potential, given its capital-light business and sustainable double-digit earnings. Utilities, on the other end of the spectrum, have regulated returns and a lower reinvestment potential. And finally, we have ESG risks and opportunities. How can ESG impact cash flows? Here we're focused on the materiality of ESG risks and opportunities to cash flows. American Water, a US utility that essentially owns the pipes that transport water. American Water is actively driving ESG opportunities by investing in pipe replacement in the US. On average, given the aged infrastructure in the United States, 20% of water is wasted. This is a significant opportunity in front of American Water. Whereas companies may be rated a higher risk rating if these risks are material to cash flows and we don't view that management are adequately managing those risk exposures. In summary, our approach to defining quality requires active fundamental research, debate, investment committee oversight, and continuous review. This process identifies our investable universe, which is around 200 stocks versus the index at over 2,000. Thanks for listening.